So this is a tech business owner in British Columbia who sold his company for multiple eight figures, so millions of dollars in cash now sitting in his corporation. And if you look at the graphic here, that cash sitting in the corporation was earning him $0 in dividend incomes, just sitting there, getting taxed on whatever interest it earned and doing nothing for his future. So back in 2018, he told the advisor something that most people would have argued with. And he said that the market is way too high right now and something bad is going to happen. And he wanted a pile of cash ready to move the moment it did, right? So the advisor didn't argue about the market. He asked a different question. When the crash actually happens, how fast can you move? Because if the answer is, I'll call the bank and apply for a loan, well, you've already missed that opportunity. So they set up two things. First, the surplus cash went into a corporate participating whole life policy where the cash value grows at 5 to 6%, tax sheltered instead of getting taxed every year in a corporate account. And second, a bank line of credit secured against the policy, right? So approved, open, and left just sitting there, nothing drawn, just ready to be there whenever that happens. Then COVID hit, right? And the markets collapsed. So you can see it right here on the graphic that the line of credit was open before the crash. So he moved in days with no application to file. So he drew about $1 million the week the markets bottom and bought Canadian bank stocks. And a year later, those stocks had fully recovered. He sold half of the position, and that half repaid the entire $1 million loan plus all the interest, and he kept the other half. So now he owns about $1 million of Canadian bank shares that cost him almost, well, actually nothing. So those shares pay roughly $50,000 a year in dividends every year for as long as he holds them, and the Canadian banks keep paying dividends. And his policy kept growing at 5 to 6% the whole time as well, because the money he used to buy the stocks was the bank's money, not the policies. So the bank lent him the cash and held the policy as collateral. So his money never left, right? So now, again, caveat is that this only worked because he had millions in surplus cash to fund a large permanent premium, a bank willing to lend against it, and the nerve also to borrow and buy while the markets were failing. So entry on this kind of structure usually starts around 500K to $1 million in premium. So a business owner with modest retained earnings can't really do that. And if the market had kept dropping, well, he still owed the bank every dollar, obviously, right? But if you've sold a business or you're sitting on significant surplus inside your corporation with no strategy for it, well, this is what's possible when the infrastructure is set up before you need it. So if you want to have a conversation to see what could apply for your situation, links below.